Okay, good morning everybody. We meet again in our lessons for today. Today's we're going to talk about the private and public limited company. So these are the types of organizations that we are going to discuss. Okay, uh, on this screen I will show you several companies that falls into the category of private as well as the public limited company. And these are the very well-known companies around the world. Yeah, some of you may have already aware of this or even know about these companies. Yeah, so companies like Google, Apple, Astra International, Telkom Indonesia, Microsoft, Tesla, and as well as Zoom are the public limited companies. Okay, and for the Sayurbox, Tani Hub, those are the startups in agriculture, as well as Traveloka and GoTo, the merged companies of Tokopedia and Gojek. It is categorized as a private limited companies. Okay, so what are they exactly? The meaning of private and public limited? We're going to find out now. Okay, I take a key terms from your book. Yeah, these are the terms that we will encounter throughout of our topics in this topic. Okay, so unincorporated company, an unincorporated business, meaning that a business doesn't have legal and identity separate from its owners. So, like we have already discussed before in our first meeting about the two types of organizations, which are the sole traders and then the partnership. So these are the examples of unincorporated business. They don't have any legal entities, so therefore the owners of this business risk to lose everything that they have. So for example, when their business have a trouble, and the business cannot pay all the debts that the company bears, then the creditor can take the owner's personal wealth to pay the debts. Okay, so it means that the owners have unlimited liabilities for business debts. So this one is very dangerous. This one is a disadvantages of unincorporated business. And then the next, unlimited liability. It has something to do with this unincorporated business, because if an unincorporated business fails, then the owners might have to use their personal wealth to finance any business debt. So there are no protections whatsoever to their personal wealth. Okay? Since they are operate by themselves, they take all the profit by themselves, but on the other hand, they also risk to lose everything that they own should a problem occur. So for example, if the business has a trouble and has a lot of debt, and if the business has tried everything to sell all the assets that the business owns and still not enough, then the owners of the business might want to sell their personal wealth to finance any business debts. Yeah, so it's very dangerous for a sole traders as well as a partnerships. Uh, we're talking about when they are when they are growing up. Yeah, so when the business of the sole trader and partnerships is growing and it's become bigger, if they don't form the incorporated business, then they risk to possess everything that they have. Okay, next is a shareholder. Basically, a shareholder is a person or organization who owns shares in a limited company. So, for example, back to our previous screen, we see in the screen there are companies, there are Gojek companies, the companies that have already merged with Tokopedia, the GoTo. Well, actually, behind these companies, there are a lot of investors. So I will name the major investors like Tencent, and then Alibaba. And then from Indonesia, I heard that PT Telkom has also shares on this company, the GoTo and the Tokopedia. PT Telkom, sorry. PT Telkom. Okay, so there you go. It's not necessarily an individual to buy a shares of a company, but another company can also buy shares from another companies. So it can be owned by a company. Okay, so that is a shareholder. Next is a private limited company. Well, often a small to medium-sized company owned by shareholders who have limited liability. The company cannot sell its shares to the general public, so it's different from the public limited company. Private limited company is the company like Traveloka or Sayurbox or Tanihub. They are the private limited company. It means that the owners of this business doesn't risk to lose everything they have, because whenever the business has in trouble, then they just lose the shares that they invest in the company. So for example, they invest like 1,000 worth of shares, yeah, 1,000 worth of shares, and when the business has trouble, they only risk to lose this 1,000 of shares. Their personal wealth cannot be affected. Yeah, it's not affected by the trouble that caused by the companies. So companies like Sayurbox, Tanihub, or Traveloka, these are the examples of a private limited companies. So the owners of this business have a very limited liability. Okay, but the problem is this private liability company cannot sell these shares to the public because they are not going public yet. Okay, next we have a public limited company. Yeah, so by the name implies, it is often a large company, yeah, like PT Telkom, Tesla, Microsoft, Apple, owned by shareholders who have limited liability. It's the same like private limited company. Yeah, their liability is limited only to the shares that they own. The company can sell its shares to the general public. Now, on the contrary to the private limited company, public limited company can sell the shares to the general public. It means that people like us, for example, me as a teacher or you as a student, can buy their shares whenever they listed in the stock exchange or the stock market. So they have a very easy way to get money from the public compared to private limited company. And then ordinary shareholders, the owners of a limited company. Yeah, it's pretty obvious that we're talking about the initial owners of the company, maybe the founder of the company, yeah, maybe the board of directors of the company, yeah, stuff like that. And then the limited liability. The shareholders in a limited liability company, which fails, only risk losing the amount they have invested in the company and not any of the personal wealth. Like I told you before, if you own a shares of a public company or a limited company for, like, for example, $1,000, that's your shares. Okay, so whenever the company has troubles or needs to pay the debt, you only risk to lose this $1,000, not all your personal wealth, because it's limited. Yeah, because it's already incorporated company. And then the last is dividend, a payment out of profits to shareholders as a reward for their investment. So as shareholders, we as a shareholders, of course, expect what we call a dividend. It's a profit from the company. So it means that when a company generates a profit from their business activity, then we as an investors has the right to have a dividend. Okay, I will show you how. Dividend is when the company generates a profit for, like, for example, $10,000. Yeah, $10,000. This is the profit. Now, for example, if the company wants to distribute only $3,000 worth of dividend to the shareholders, and the rest $7,000 will be taken into their retained earnings, this will be distributed to the shareholders. Yeah, this $3,000 will be distributed to the shareholders. So therefore, the company has two options. Yeah, if they generate profit of $10,000, option number one, they can keep all this profit for the companies, yeah, for expansion, for investment, things, stuff like that, or they can share the portion of this profit. For example, option number two, they want to share $3,000 out of $10,000 to the shareholders as a dividend of this profit. Then the rest of $7,000 will be kept by company to invest any investment or to expand their company or to expand their businesses. Okay, so that is the dividend, a payment out of profits to shareholders as a reward for the investment. Okay, now we proceed to the next slide. Now we're gonna have a look at the differences between the private limited and public limited company. In terms of the owners, yeah, private limited usually a very small number of shareholders. Yeah, usually it contains friends, yeah, family, or even colleagues. Yeah, we have many examples here in Batam. Yeah, there are so many private limited company that owned by by family member or friends. As for the public limited company, is usually a very large number of shareholders because, like I told you before, public limited company can be owned by everyone in this country. Yeah, so like PT Telkom, for example, it's a public company, so everyone in Indonesia can buy PT Telkom. So it can be a very large number of shareholders, not only the founder of PT Telkom, but also the people of Indonesia. And then in the terms of the size, usually the private, the private limited company, quite small. Yeah, it's not very big, but it's quite small. And for public limited company, most common form of the organization, very large companies. We can say that companies like Apple, yeah, or Microsoft, it's a very large company. They have offices around the world. They have branches around the world. So we can say that their company size is quite big and quite large. And in terms of next, in terms of sale of shares by the company. So for the private limited company, can only be sold privately, often to family members, friends, or employees. It means like this: when the company needs money, yeah, needs to find another money or need to fund their business, they need to issue shares. Okay, they need to issue a shares. But the problem is the shares can only sold privately, yeah, to the members of the company, to the family members, to the friends, or even to the employees. Yeah, so it's very, very limited. Yeah, very, very limited options. As for the public limited company, whenever they want to have additional fund, yeah, they can offer their sales. First, they issue their shares, and then offered it to the general public or other organizations through the stock market or through the stock exchange. Yeah, so it is different in terms of sale of the shares by the company. And then the sale of shares by shareholders. Yeah, often for the private limited company, it's often difficult to sell as must be sold privately and with the agreement of other shareholders. So let's just say, for example, you own a private limited company, and for some reason you want to sell your shares to others. Now, you must sell it privately to other members of this company. And whenever the other members of this company do not agree when you want to go out of these companies, then you cannot go. So it's very difficult if you want to sell it as a private limited company. As for the public company, it's very easy. Yeah, it's quick and easy. They can be offered for sale to the public. So, for example, if you own the share of PT Telkom, you can sell it whenever you want. Yeah, it's easy. It's easy that as it's there. Yes, that is. So it's very fast and it's very quick. It's easy. Whenever we own a public limited company's shares, yeah, when you need money and you can sell it right away. And then in terms of control, only few shareholders, one shareholder may own 51% of the shares in the company, and so has control over major decisions. Ownership is not separated from control. So bear that in mind. Ownership is not separated from control. So it means that the owner can control the companies the way he wanted. Okay, and only few shareholders. Yeah, not so many, only few. And if one owns 51% of the shares in the company, so he has the control over major decisions. Yeah, meaning that every decision that he make, everyone must agree upon it. On the contrary, on the public limited company, usually it's owned by thousands of shareholders, and they have what we call the board of directors, yeah, appointed by the shareholders at the annual general meeting. So these directors have control over the business policy. Yeah, where do they want to take their business to? Where do they want to implement of the strategy of the business? It's made in the board of directors. The owner of these companies do not have any control over it because ownership and control are separated. Okay, and then raising additional capital through share issue. Even if successful, it may be difficult to raise additional capital as shares cannot be sold to the general public. It's also the same like this one, sale of shares by the company. It's very limited, yeah. It can only be sold privately, so we cannot raise money We cannot raise additional so much capital because we cannot sell it to the general public. And it's contrary to the public limited company. It can raise a very large sums quite easily through the sale of additional shares. Of course, because they are already public. Yes, so it's very easy. And then the borrowing finance. So whenever the business wants to borrow money from another party, as for the private limited company, it's very difficult because they, like I told you before, they are still small and they have a very low value assets to offer as a security, known as collateral. It means when they want to have when they want to seek additional funding, they may want to have a collateral that has a very great value. And that's difficult for a private limited company because the size of the company is still very small. On the contrary, the public limited company has a very large sums of interest, and they have a very valuable collateral because they have already big. Yeah, they have already big. They own a lot of assets that has very high value. Yeah, so can often raise very large sums at good rates of interest because of its reputation and valuable collateral. So these are the differences, the main differences between the private and public limited company. Now we're going to have a look the disadvantages that the public company has, which the private company doesn't have. Yeah. So the first is the legal formalities of setting up a public limited company are very costly. Of course, when you want to go public, there are so many things that you need to pay. Yeah. For example, the cost of listing your company in the stock exchange, the cost of hiring an auditor to audit your finance. Yeah, there are so many things that you need to pay. So it's very costly compared to the private limited company, because the private limited company is only that. Yeah, because it's privately owned, it doesn't have to, for example, pay a listing fee to list on the public exchange because they're still private. Yeah, but for the public company, they have to, because if they want to be listed alongside another company in the stock exchange, they need to pay a lot of money. Yeah, to get listed. And then the second disadvantages is directors' decision making is sometimes influenced by major investors who seek to satisfy their own objectives. So it looks like this. If you, for example, like Gojek, is the major investors are Alibaba and Tencent. Yeah, the major investor of Gojek are Alibaba and Tencent. Now, for example, if Gojek usually pay dividend, yeah, for like 10% a year or 10% per 6 months, yeah, then the Alibaba and Tencent executives might come to Gojek and tell them to, hey, come on guys, raise a bit of the dividend. Yeah, why don't you make at 30% dividend, yeah, to be given to the shareholders. Now, so it means that the Gojek cannot make the decisions because it's often influenced by the major investors. Yeah, what the major investor want, then Gojek must come into considerations. Yeah, so that is the one disadvantages of being a public limited company. Okay, so the example, the major investors might demand that the directors pay higher dividends than they had planned. This reduces the profit available for reinvestment into the company. So like I told you before, so if Gojek planned to give only 10% of the profit to the shareholders, and the other 90% will be kept to expand their business or to reinvest in another business. But since the major investors like Alibaba and Tencent came to Gojek's director and tell them to raise the dividends ratio to 30%, they risk losing chances of investing in another business because of these influences. Okay, so that is the second disadvantages of public limited companies. The third disadvantage is the company is always at risk of takeover by another company because its shares can be freely bought and sold. Yeah. So the one case that have already happened in Indonesia is Indosat. Indosat. Back in year of 19, I don't really remember what the date is or the year is. Indosat was once an Indonesian-owned company, yeah, and they have already gone public, so they have this title TBK. But then again, back then, President Megawati decided to sell the shares of Indosat to Ooredoo of Singapore. Okay, now, so in this by this example, it is pretty obvious that any public company can be bought by another company. So any other business needs only to buy 51% of the shares in the company to become the new owner. Now I don't know how many shares that they already bought, but I think Indosat now is not Indonesian company anymore, but more like private or uh, dimiliki oleh orang asing. Yeah, so Indosat is owned by other companies, yeah, foreign company like Ooredoo. Yeah, so that is the third risk or the third disadvantages of this public limited companies. The last disadvantages is that the legal requirements for the publication of information about the company are much stricter than they are for private limited companies. Of course, the legal requirements for whenever the company wants to go public is always stricter. Yeah, because why? Since the company wants to go public, it means that people needs to know the operational of the business, the financial of the business conditions. So they needs to come very clear about what they are. Yeah, not there is nothing to hide anymore because it's going public. So the people have the rights to know whatever happened in the public company. So contrary to that, the private limited company doesn't have to be like that because again, it's only owned by a limited numbers of family members or even friends or even employees. Yeah, stuff like that. Okay, so I guess that's it for today now. I hope you understand the meaning of these private and public limited companies, the advantages and the disadvantages of these companies. In the next meeting, we're going to talk about another types of organizations. Yeah, we're going to talk about the franchises and the joint ventures. Okay. Now, thank you so much for your attention. I hope this will be useful for you, and I'll see you then. Take care and bye bye.